on board Dharmesh Shah, who's the head technical at ICICI Direct, to basically understand how the setup for the market is looking like at this point in time. Thank you so much, Dharmesh, for joining us on ET Now. And first question being that what should one expect? Because I'm sure the charts must be going all over the place with the news flow being so volatile.
So good afternoon. Yes, definitely. I think so. The things are not in line with the expectation. But yes, we believe I think so. The market should form a more of a higher base formation in this current corrective phase. If you look at the market, I think so from 21,900 to 23,800, we are almost 2,000 points lagging without any major corrections. So always market requires some of the other reason to fall. I think so. Previously it was earnings, then it was F5 flows, off flows. This time it looks like I think so that the Trump tariff war. I think so that is something putting the pressure on the Indian market. We believe I think so market should see a more of a higher base formation in this range of 22,500 to 22,800 remains to be the very strong support for the Nifty, and we expect that to hold in this current corrective phase. And maybe by next week things should start getting settled and we should see a pullback happening towards 23,500 to 23,800, which was the previous side. So I think so more for consolidation. Let us not forget we are entering into the result season. So yeah, we may see a more of a stock specific action going forward for the market. So more of a consolidation is expected in this range of 22,500 to 23,800 going forward.
Right, Dharmesh, hi, good afternoon. This is Ankita also joining in. Cheryl, you were asking what is happening to the charts. The charts are clearly off the charts right now. But Dharmesh, let me come to you with a pack which has been dealing under a lot of selling pressure of late, and that's Nifty IT. How do you play that counter? More pain left there because we were expecting Nasdaq for a further fall, which we saw coming yesterday. 6% fall on Nasdaq. Indian IT continues to reel under pressure. We are trading with cuts of 3%. Further pain left there?
Yeah, if you look, I think so, post-Trump tariff war, I think so, the chart seems to be not so great for the IT sector. And I would like to say that we should be focusing more towards the domestic rather than to the export-related side. So yes, if you look at the index of Nifty IT, I think so, the long-term trend line joining the lows of 2020 and 22, I think so that has seen a breakdown. And we believe, I think so, this breakdown should continue going forward also, where the corrections or a corrective phase for the IT sector as a whole should continue. So yeah, as a sector, I think so we should avoid maybe I think so things have too much of a oversold territory right now in IT sector. So minor pullback cannot be ruled out. But if you talk from the medium term perspective, I think so IT as a sector should remain under pressure going forward. So it's a more of a I would say a technical pullback should be looked as an exit opportunity in most of these IT stocks.
All right, so that's about the IT pack. Dharmesh, is any of the sectors looking good to you at this point in time? Do you think there's any place that one can venture, given the fact that yes, this tariff, the tantrums, the way how the markets are actually reacting, ultimately is just a near to medium term blip that you will see in the markets, right? Long term story hopefully will remain intact for India. And are charts reflecting any of the sectors that we can look at right now to buy on dips?
Yes, definitely, if you look, I think so. The Indian story, I think so. We have the structural bull market, and inside the structural bull market, corrections are part and parcel. That is what right now happening in the Indian market. Coming to the sectors, yes, definitely we focus towards more towards the domestic side. I think so. It's the right time to stick to domestic side, where again the sectors like banking, again financials. If you look even in this current corrective phase, banking as a sector clearly is showing the relative outperformance even in this current corrective phase. So yes, banking as we are moving towards the RBI policy next week, expecting a rate cut, and things should get better overall for the banking as a sector. So yeah, we remain to be positive for banking as a sector. But again, inside the banking, we remain to be constructive positive for NBFCs, where stocks like AB Capital or something like L&T Finance are the ones where we believe I think so 10 to 50% upside cannot be ruled out from the current levels. So banking again, private as well as PSU banks both looks positive. Apart from banking, again we remain to be positive for PSU stocks. Now coming to PSU defense as a sector, which was not which was in the corrective phase for last 6 months and seems to be I think so the most of the negative news seems to be getting priced in the defense. So yes, defense as a sector we remain to be positive for. Stocks like HAL or Cochin Shipyard are the ones where we remain to be positive going forward. So PSUs, banking, metals, now metals, I think so it's a mixed picture right now, but talk from the medium term to long term, the way the dollar index has seen a sell-off from 110 to 102, it looks like something bit positive for metal as a sector. Maybe I think so the short-term pain, maybe because of sentiment we are seeing right now, selling pressure happening in most of the metal stocks. But to talk from the medium-term perspective, I think it's the right time to accumulate good quality steel stocks like Tata Steel, SAIL, JSW Steel, other ones. One should definitely look out from the medium-term perspective.
All right, Dharmesh. So, financials, banking specifically, the PSU names, metals, that's where you're seeing value. But on that note, thank you so much for joining us and taking the time out. We will let you go on that note.
If you like this video, then like, share and subscribe to ET Now.